You mentioned Universal Life taking off in the 80s, and it was just kind of a perfect storm against whole life at that time because interest rates were high. And if with a Universal Life, you're looking at new money rates, right? As interest rates were high, you could get a very high interest rate early on. But then when interest rates started to drop, you would feel that immediately in a Universal Life contract. And some people bought Universal Life and paid a premium level that was just enough to cover the contract through their entire life if interest rates stayed at those levels. Well, when interest rates started to drop, then the premium level that people chose in a lot of situations was not enough to carry that contract.
The policies that someone bought in the 80s, 25, 30 years later, were not growing as they were illustrated when the product was purchased. And the policies end up blowing up on a lot of people. I would say grandma and grandpa's, when they need the death benefit, it can be gone because of that cost of insurance. And there's no cash value left.
Would stop short of saying a lot of people. I don't know what the count was, but certainly that did happen with some people. That's one of the things about Universal Life. It's a very flexible contract. And there's some great things about that. There's some challenges with that.
IUL contracts can look attractive from an illustration perspective. And then they limited how people can illustrate those policies because there's a difference between average rate of return and actual rate of return. One of the most naive comments I hear from the consumer is, look, the market's average 9%, so I can expect at least 8 for the rest of my life. And it's such a naive comment because they don't understand in 1 year that a negative 10 is going to make a drastic difference on account values. What's up, everybody, and welcome to another episode of Cash Flow Conversations. Today I have a wonderful guest who I've known for a number of years now, Mr. Clay Summers, who has spent over 4 decades in the life insurance industry. Now, a lot of people, listeners might know I started my career as an architect. I went to school for architecture and somehow got involved in life insurance. And I never thought I'd be doing this, but I find it fascinating. And it's amazing to me how I can help business owners have access to capital in any economy with guaranteed growth of their cash and all of these tax benefits where they can take care of their family. Life insurance becomes a phenomenal tool for business owners that want control over their capital. And there's different types of life insurance policies that exist, especially permanent life insurance policies. There's universal policies and there's whole life policies, and they're drastically different, but the consumer really doesn't know much of how they differ. So in this episode, I want to pick Clay's brain, who is kind of a product specialist and has, like I said, decades of experience with different types of policies. So today we're going to unpackage how indexed universal life insurance works and then kind of compare it to whole life insurance so that the consumer can understand what they're getting into. So Clay, it's great to have you here, bro.
Thanks, Matt. It's always a pleasure to be with you.
Yeah, man. And so life insurance, what an exciting topic, isn't it?
For some people it is, and I'm sure for others it is not.
Well, the purpose of this is that, look, people probably aren't excited about life insurance, but they surely are excited about what it can do for you. And so I wanted to dive in today and not have an opinion-based conversation, but an objective-based conversation on how different policies can set up. What are the risks that are inherent in different types of policies that people might not be aware of, and not talk about why I like this or this is good for XYZ. It's here's the pros, here's the cons, so that the consumer can really make a better decision.
Sounds fair enough.
So indexed universal life insurance. Product's not that old, especially compared to whole life insurance. So what's some history on indexed universal life insurance? How did that come about? Because you mentioned earlier there's different types of universal. So the difference here is that there's universal and then there's whole. And then universal has different ways that it can grow. So why don't we start in like how universal insurance started and the different designs that it's gone through?
Well, thanks, Matt. And you're right. Universal life in the, as you look at life insurance in general is actually a fairly new product. Universal Life came out, I think, in the mid 70s and became really very more prolific in the 80s. And we've had, I think, 4 major variations of Universal Life since that time. The first one that came out, today we call it traditional Universal Life. It was really just called UL, Universal Life. And then I believe we had the next step was a variable Universal Life contract, and that was, I think, around the mid 80s. And then we had something called secondary guarantee Universal Life that came out in the very early 2000s. And then indexed Universal Life, which I think followed very shortly thereafter, probably about 2008, I think, might have been around when IUL was invented. But if you notice all of those contracts, I like to split them between, the return component and the chassis. So you remember I mentioned UL, VUL, SGUL, IUL. So like the I in IUL is the return component of that product.
Or how
But
the
notice
product,
what's
or
that?
how it grows, you mean? So the universal is a chassis, then the growth component is like how the underlying asset is actually growing or not growing inside. So the cash value going up or
Yes.
down.
And that's true of all of those except SGUL, and it's just a little different. But notice all of those end in UL. And
Mm-hmm.
so they're all universal life contracts. So they all sit essentially on the same chassis. And so one of the first things I do when I try to compare whole life to universal life, and whole life, by the way, has been around at least a century.
Yeah.
How I try to compare those two is I look at the chassis. In other words, what kind of guarantees, what kind of things do the chassis bring to the client? Does that make sense?
Yeah. Yeah. And so let's talk about the growth component first, and then we'll talk about the chassis. So the two that stick out to me that I think most people talk about is the VUL and the IUL. IUL stands for indexed universal life. So your return is based on an index that you can choose. And VUL is variable universal, which is a securities, right? That's a security that
Correct.
has much more volatility. So explain the difference between those two.
Well, variable universal life is your cash value is essentially invested directly, in the market. In other words, you would participate. The return that you would receive would participate 100% in market movement, and so the market can be up, but guess what? The market can also be down. So you could actually lose money, in a variable universal life policy because the market may be up or down. Index universal life, or actually, the kind of funny thing is when the product first was introduced, it was called equity indexed, EIUL, and they very quickly dropped the equity because what happened was I think people got confused thinking that their money was actually in the market, and with an index universal life, that is not the case. The only thing that you can earn in an index universal life is interest, an interest rate, but that interest rate is tied to market movement. And it's usually tied to some type of index or indices, such as like the S&P 500 index. So if S&P 500 index goes up, perhaps you'll have a little bit higher interest rate. If it goes down, it'll be lower. Generally, there's some type of limit on how much of that market you can participate in. And sometimes there's almost always a floor. And the floor sometimes is like 0% return, or sometimes it'll even be like a 1% return or something. But then there's always a cap. There's always some type of upper limit. In other words, you can't participate in 100% of the upside because they're taking away some portion of the downside. So that's how indexing works, essentially.
Who's they?
Well, so if you have an index universal life, your contract is with the insurance company, and the insurance company is the one then that credits interest to your account. However, very few insurance companies actually take the market risk themselves. They usually offload that market risk to a third party, and through investment bankers, through the investment of derivatives options, if you will, to determine the interest rate that you're paid.
Interesting. So if the market does 20% return, and you would be capped out at a number 8-9%, and anything above that, then the insurance company keeps?
Every contract's different, but what you've described is a very common way for an index universal life to have an upper limit on how much of the market that you would participate in.
Okay. I'm going to explain something and tell me if this is accurate. My understanding is back in the 70s, interest rates were high, and whole life is considered a fairly boring product. I always call it the tortoise and the hare race. It's just slow and consistent, and you're never going to have an exciting rate of return one year, or you typically don't have an exciting rate of return in a year, but you certainly don't have the downfalls. The hare ended up taking a nap and lost the race. So I consider whole life the tortoise in that scenario. And the way I understand it is insurance companies wanted to be competitive. And so in the 70s, when rates were high, people were dropping their whole life policies because they could get a better rate of return in a CD. And so the insurance company said, okay, well, let's give you the opportunity to chase the rate of return. and opportunity to get a higher rate of return. However, we're going to reserve the right to charge you the cost of insurance every single year, and that cost goes up. So they basically offloaded the risk of the return from the insurance company to the insured in order to grab more market share, because it's kind of more of an exciting upside than what whole life could have. Was that accurate?
Well, there's a lot there to unpack. But you're right about whole life insurance back when interest rates soared. So now you have, whole life is definitely a fixed financial instrument, right? And so when other fixed financial instruments, new money rates soar, whole life can't do that, right? Because whole life works off of a portfolio rate. In other words, all of our general account, an insurance company's general account is what, credits essentially the return that you see inside a whole life policy. And so, whole life, and it depends on what type of whole life policy you're talking about. But for today's purposes of today's discussion, let's whenever we talk about whole life, let's assume we're talking about a participating whole life policy with a mutual organization. In those
Absolutely.
situations, the policyholders are generally eligible to earn dividends in the contract. So they usually have some type of guaranteed return, or what we call guaranteed cash value in the contract. And that's scheduled. That can't change. But if the company does better down the road, they can actually credit a dividend to the policyholders. And those dividends come if they're usually made up of three things. You've got essentially expenses, mortality, and interest that the insurance company would earn in the market. And so if an insurance company experiences better, has better experience than they planned in any of those three things, then dividends should go up, right? Yeah. And of course, vice versa. So when interest rates spike, an insurance company can invest new money-wise, new bonds, and in those higher returns. But most of the money that's sitting in their account has been invested in the past. It's still earning those fixed rates that they purchased. So it takes a long time for the interest rate component to make a big difference in the cash values or in the dividends that might be paid. And so it's a little bit of a slower responding contract. Whereas with new money, you can go right out tomorrow and get a little higher rate. But who knows what new money is going to be forever. So right. Whole life is just like you mentioned. It's a little bit of everything just happens a little slower than than some people might like or might think would happen. And then I think your next, well, go ahead.
I was going to say that's the opportunity really for business owners, is that it's going to not react to the market, and you have available cash so that the individual can respond to the market in a way that they want to control. If they want to go buy new money, assets or investments, whatever it might be, that capital is going to be there and they can react. But the product underlying is just nice and consistent.
Well, and then you mentioned, Universal Life taking off in the 80s, and it was just kind of a perfect storm against whole life at that time because interest rates were high. And if with a Universal Life, you're looking at new money rates, right? And so as interest rates were high, you could get a very high interest rate early on. But then when interest rates started to drop, you would feel that immediately in a Universal Life contract. And some people bought Universal Life and paid a premium level that was just enough to cover the contract through their entire life if interest rates stayed at those levels. Well, when interest rates started to drop, then the premium level that people chose in a lot of situations was not enough to carry that contract. And so you saw a lot of people with policies that began to become in trouble or underfunded. And then your only option at that point is probably to fund them at a higher premium level. Yeah. And sometimes that's not even possible to recover from.
Because in other words, you're saying that the policies that someone bought in the 80s, 25, 30 years later, were not growing as they were illustrated when the product was purchased. And the policies end up blowing up on a lot of people. I would say grandma and grandpa's, when they need the death benefit, it can be gone because of that cost of insurance, and there's no cash value left.
Well, I don't know how, I would stop short of saying a lot of people. I don't know what the count was, but certainly that did happen to some people that they, that's one of the things about Universal Life. It's a very flexible contract. And there's some great things about that. there's some challenges with that. Because it's flexible, it means you, the client, can set your premium level within, I'm sure, within some restrictions, depending on the contract. And so you can set it at a lower premium level or a higher premium level. And the thinking there is you can decide to either build higher cash value or lower cash value in your contract. But here's the problem. If down the road your return is not as you expected, or if the internal charges of the contract, which are sometimes also variable in the policy, if those increase beyond what you were expecting, then the premium level you had chosen may not be enough to sustain the contract. And so then you either have to increase the premium, or the policy could be, underfunded and headed towards lapse. So there could be all kinds of issues. But to me, the trouble is, if you want to call it trouble, is that the company transfers the onus of keeping the policy in force essentially from the company to the client. And this is one of the biggest differences I see between any type of universal life and whole life insurance. With whole life guarantees, as long as you pay your premium, that the policy will be in force until you die. And that's because of the way it's priced. You have a certain cash value level that's required to build. You have a premium level that's required to be paid, and then you have a death benefit that's guaranteed to be paid. So down the road, clients have to pay that premium or use other assets to pay the premium for them, but they can't change the premium, right? And the return that's been assumed in the contract that determined those premium levels is guaranteed. Whereas with a universal life policy, and again, not all universal life policy, but many universal life policies that you would see, this is not the case. You can kind of change the premium. You can change the billed premium. In other words, if you're being billed for $500 a month and you decide you want to be billed for $300 a month, you can generally make that change. And, inside the contract, the charges or the return, things can change that can cause that policy to be on a path towards lapse or a path towards being underfunded. And that's one of the biggest differences between the two contracts. Does that make sense? And hopefully I'm making myself clear.
No, it totally makes sense. So, like I said, the risk is on then the consumer to keep it going, and the older you get. So talk about...
That's true of not of all contracts, but true of some universal life policies.
So there's so much to unpack. So in whole life, you can stop premiums after 7 years. You can do a reduced paid up. And you reduce the death benefit and the contract's paid up and guaranteed to stay in force. What are the options with IUL?
I don't know all IUL contracts, but I can tell you in the past, I've looked at several universal life policies. If they offer a non-forfeiture option for reduced paid up, the way they do that, which is kind of funny, is they exchange that policy for a whole life policy and then make it reduced paid up. So
they do.
There you go.
That's kind of
again.
Funny. Okay.
I can't speak for every contract, but the ones, some of the ones that I've seen, if they offer a reduced paid up, you have to go to whole life, and then they can make that reduced paid up.
So IUL contracts can look attractive from an illustration perspective, and then they limited how people can illustrate those policies because there's a difference between average rate of return and actual rate of return. And one of the most naive comments I hear from the consumer is, look, the market's average 9%, so I can expect at least 8 for the rest of my life. And it's such a naive comment because they don't understand, in 1 year, that a -10 is going to make a drastic difference on account values. So talk about the illustration process for IUL, because they can illustrate quite well.
Well, generally with, IUL and with many UL contracts, there is a big difference between average and actual, right? Because almost all, not all, but almost all of the illustrations I've seen for IUL, the values are illustrated at an average rate of return. They usually have some type of a look back to determine what the average rate of return would have been over a 65-year look back and over every 20 years or something along that line. In any event, that average rate of return is then projected linearly every year forever. And of course, with IUL, the whole idea is that you probably will not earn the exact same interest rate every year forever, right?
Probably or likely.
Well, I'm being I'm being a little cautious in my wording here, but yes,
love
I
it.
mean obviously that rate of return can vary. The odds of getting the exact same return every year be almost that'd be crazy.
Yeah.
But in any event, anytime you face that situation, you run the sequence of returns risk, right? So if you were to get a very low rate of return early, or zero rate of return in some cases early, and then your better returns later, that has nothing to do with an average rate of return illustrated, right? It just would be a completely different outcome. And so obviously, depending on the rates of return that you earn in the actual way that you earn them, you could put the policy at risk of becoming underfunded, something along that line. Now, it kind of depends on the policy and how the policy was set up and the premium level you chose to pay. I will say, sometimes index universal life policies are illustrated at close to like the maximum premium level, or somewhere at a very high premium level. In those instances, that policy would probably be, almost impervious to a lapse down the road if the client keeps that at that level and doesn't make other changes. For instance, client can always withdraw money from well, not always, but usually once you're past a surrender charge period, a client usually has the ability to withdraw substantial amounts of cash value. Well, if you withdraw those cash values, then the return on those cash values will never be there in the future. And so a lot of things that the client could make a change with in the contract could put it on a path towards becoming underfunded.
Can you borrow against IUL?
Yes, I imagine you can borrow against almost any index universal life policy.
And so when I borrow against it, I'm creating a loan. Does the underlying asset get affected? Is the growth going to get affected if the money's out?
So there is a big difference between a withdrawal and a loan, right?
Yeah.
A withdrawal is something when you take the withdrawal, that money is withdrawn and is never paid back. The only way you could pay that withdrawal back would be to pay new premiums into the contract, and that's a different thing. With a loan, anytime you borrow against almost any type of permanent life insurance policy, whether it's whole life or index universal life, you actually don't borrow the money directly from the contract. You borrow the money from the insurance company, just like you borrow from any financial institution. And then you pledge that amount of money in cash value from your policy as collateral against the loan, so that if you defaulted on the loan, the money that was in your policy would serve as the collateral. But with index universal life, and let me tell you, I've seen a lot of different types of loan provisions. In fact, some of the policies today have 3 different ways to borrow against the contract. So there's a lot of different things. But in many situations, when you borrow from an index universal life policy, they're going to move the money that's held as collateral for the loan that you've borrowed into a different option, interest-bearing option for cash value, right? And so sometimes they'll move it into a fixed option, or sometimes it'll move it into an indexed option that the company controls rather than you, and sometimes not. But if depending upon what they do with the collateral cash value, that will have everything to do with what your loan interest rate is. And so you may have a variable loan interest rate, you may have a fixed loan interest rate. You really need to read through the contract and understand the ramifications of borrowing against an IUL, because there's so many different options. With whole life, you don't see that many options. Usually there's either a variable or market loan rate or a fixed rate. And then some companies, depending upon the borrowing against the contract, some companies may put some limitations on the amount of dividends that are paid if you have a loan outstanding, but it's just a completely different kind of a system.
Yeah. Because some whole life, if it's non-direct recognition, it continues to earn dividends as if the money was still in there. And so what I hear you saying is that might happen with IUL and it might not.
Yeah. Except that, IUL doesn't pay dividends.
Sure.
Again, it's just but I think you get the picture.
Yeah. Okay. So you talk about overfunding, which is a great way to illustrate a contract because it can look so robust. when you overfund IUL, uh, what's what happens with the contract? I hear people talk about cost of insurance inside of IUL, and that's a moving number each on an annual basis, right?
So, two ways. Usually, again, every contract's different, but in the vast majority of IUL contracts that I've seen, there's usually a current level of costs of insurance, which is mortality charge for the net amount at risk that you have in the contract. So if you had, let's say you had $1 million policy, and let's say at any particular point in time you had $400,000 of cash value. Generally, that would mean you have a $600,000 net amount at risk. That would be like the pure death benefit portion of the contract. So that's the portion where you would have to pay the costs of insurance, the mortality charges for $600,000 worth of what is essentially like 1 year term insurance, if you will, inside the contract. Now, that cost of insurance is going to change every year. As you get older, the cost per thousand of coverage will change, and generally it goes up as you become closer and closer to being older. In any event,
is that in the illustration? Does it talk about that cost of insurance?
So yeah, in the illustration, it does. There's generally a level of current charges that the company is currently charges. It'd be a per $1,000 rate of coverage charge, and those would be what they're currently charging. But then there's also usually a maximum charge. In other words, the maximum that they could ever charge per thousand at every age for that coverage. And so a company then would charge really anything they want up to that maximum. So they could stay at their current level, or they could increase that, or I suppose they could decrease that down the road. But the maximum charges are what's usually printed in the policy pages. But in the illustration, a lot of times what you'll see is there'll be usually have like 3 different sets of illustrated values. You've got a value that's based on current assumed interest rate, which is a lot of times an average interest rate, linearly proposed, and then current costs of insurance. And then there'll be some type of guarantee, and there'll be like the guaranteed return that the policy would pay, plus the guaranteed COIs, the guaranteed cost of insurance. And then there's usually something in the middle, and either has like current or maximum or average or something like that. And so if you're buying a policy, you would want to look at all 3 of those sets of values to determine, just about where your contract would stand, because things can change, right? The insurance company could change those COIs, and certainly your return could change down the road.
So let's say you have cash value. Can you use existing cash value when you're older to pay the premiums that are going to be due?
I would imagine that with a universal life policy, that generally happens automatically. And so the way most universal life policies are administered is they're administered on a monthly basis. You might even be familiar with the term month-iversary. So if you buy your policy on the 12th day of the month, every month your policy will renew, if you will, on its on the 12th. It's their month-iversary. And that's usually when they apply all the charges and look at the premiums and cash value that's paid. And the way those systems generally work is every month on that date, they take a look at all the premium that's been paid in that month, plus all the cash value that's available in the contract. And then they compare that against all the charges, right? And the charges would include the mortality costs, plus there's generally an array of charges like a premium load or a policy fee or a per $1,000 charge, or there's usually 3 or 4 different charges. And most of those charges in many situations are variable. There's a current level and they could increase or decrease. But in any event, the company would then charge all of the charges for that month, and they look at the premiums and the cash value. And if the premiums and the cash value are higher than the charges for that month, then it just moves to the next month. And so if the premiums weren't sufficient to pay all those charges, then the cash value would just simply come down to pay them. And so then the policy would stay in force. It would move to the next month. The thing to understand with that, I think, is that generally the system doesn't care how high your premiums and cash value are. So if the system looks at that and you have a penny more than all your charges, it's good. It moves to the next month. If, for instance, you had $1 million of premiums and cash value versus a small amount of charges, great, it moves to the next month. But it doesn't care generally how well you're covering those charges. In other words, it's not really, you know, the onus again is more on the client to make sure that the premiums and the cash value that's in the contract are on a path towards keeping that policy in force as long as the client is expecting it to stay in force. So the company's not caring as much whether you're funding it. You mentioned overfunding or maximum funding or minimum funding. The company doesn't care because it's your contract. You can kind of do what you want with it. With whole life, that's just not the case. With whole life, the premiums are prescribed, the cash value is prescribed, because based on actuarial pricing, the contract is designed to, be guaranteed to be in force all the way in through your whole life, right? Through all the way until you pass away. And so if they've, and generally those pricing of those products are a little bit conservative, which is no problem, because down the road, if the company's been too conservative, then you should be able to reap the benefits of that in the form of a dividend, right?
Which brings up a question about,
and remember though, dividends are never guaranteed.
Of course, dividends are never guaranteed. There's two components in whole life: guaranteed and then non-guaranteed.
Correct.
Non-guaranteed is the dividend side, because you can't guarantee the insurance company is going to be profitable. But with whole life, you're investing in the profitability of the insurance company rather than tied to an index or a stock.
Well, maybe a better way to look at that is that with a whole life policy, a participating whole life policy with a mutual organization, the client is actually an owner of the company. The company is owned by its policy holders. So like any company, at the end of the day or at the end of the year, if the company has made a profit, it returns its profits to its company owners. And so in a mutual organization, our company owners are the policy holders. And so they would return those profits to the policy holders in the form of a dividend. And remember, generally profits come from three ways in a whole life contract: company expenses, mortality, and then interest or return that the company earns on its general account. And so if expenses are low and mortality is low or near where we thought, and interest rates are high or above what they thought, then a dividend would probably be paid.
Okay, so really quick, kind of off topic, but this is something I want your opinion on this, because so in a universal chassis, my growth is tied to some other asset, whether it's an index or some variable equity. In whole life, my return is tied to the profitability of the insurance company. No? Help me out.
So let's back up a little bit. Index universal life, the return on an index universal life comes from the insurance company's general account return, just like it does for whole life. The difference is that with an index universal life, that general account return is used to purchase options, to derivatives, to get that market performance participation. So in effect, the general account return does still have an effect on the return that you would receive ultimately on the contract. Because if general account returns are down, then when a company goes to that third party to purchase those options, they may get a better or worse deal on being able to deliver caps and par rates or whatever the limits are whatever the rules are that deliver the market participation to the IUL contract. So the general account of the company still has quite a bit of an effect on the amount of participation you would have in the market. Does that make sense? And then with whole life insurance, you're essentially correct. If you in a mutual organization where you own the policy and you're then essentially an owner of the company, then your dividends would be from how well the company has performed, and generally, and would be paid. I know that's probably way more than you want to know about. Return.
No, that makes a lot of sense. So banks fail, have a number of banks have failed in the last 20 years. And it's funny how people are can be more intrigued on, um, or more interested in investing in something they don't understand, like the market. And then their concern is, well, if I'm invested with an insurance company, what if the insurance company goes under? Can you talk about the risks that an insurance company might have, and is that something that is common, or that is it a valid concern? Talk about that. Like, do insurance companies go under often, or
You know, certainly there have been a few insurance companies that have had financial difficulties in my tenure, in my 40 years. I can certainly think of, when you think of major, semi major insurance companies, I can at least think of a handful in the 40 years that have had financial difficulties. In all of those situations, what has actually happened is the state insurance department has stepped in and helped that company find a buyer, another insurance company that would absorb either buy the assets of that company and but essentially take over all of the contracts, all of the guarantees that were made by that insurance company. And so in every situation I've seen, that has occurred, where another insurance company has taken over the other insurance company, and then by law, they would have to honor all the guarantees in the contract. And so that becomes important. This would
yeah,
be true of Index Universal Life as well, right? So if an insurance company were having financial difficulties and they had a UL contract, the company that might that ends up absorbing that company, or taking on reinsuring that risk, or taking on those contracts that other insurance company has written, then they have to honor those guarantees. But just remember, the only thing that they have to honor is the guarantees. They would
correct.
not have to honor anything, above and beyond that. And so that's why, at the end of the day, guarantees are very, very important in an insurance contract, because in fact, insurance companies don't have to actually be in financial trouble to offload their business to another company. They could actually sell blocks of business to another company if they just got tired of administering it, or for whatever reason, they can sell a block of business away. And we've seen that, where an insurance company has sold a block of its business to another insurance company. And then again, that company would only have to honor the guarantees that are in the contract.
And if you were to put it simply, I know you're very careful with your words, so I appreciate that. Which contracts have more guarantees, IUL or whole life?
Well, that would vary from contract to contract. But I will say this. Every whole life policy is, it's priced to be in force all the way through the policy maturity. And today's policies, the policies that are sold today, the age of maturity is 121 years old. And so policies that are priced to be, essentially, the client then only has to pay the premium. And that's the only thing the client needs to do to keep that policy in force through age 121. And so with universal life policies, you'd have to look at the illustration. And so if you look at the illustration, and I would go to the guaranteed, values. Usually, again, remember, there's two guarantees there. Usually you'll see the guaranteed return and then the guaranteed costs of insurance. And look at that column and see if there's cash value and death benefit illustrated all the way through age 121. If that policy has values through 121 at that premium level, then that policy is guaranteed to be enforced. But you have to pay the premiums. And remember, with a universal life policy, the client usually can control how much premium they pay. So even though at issue and it's showing those premiums being paid, if you don't pay those premiums on time, or if you pay less premiums, now you could change the guaranteed structure of the contract. Whereas with whole life, that can't happen, because whole life premiums have to be paid every year. Now, you could pay them by using dividends to pay those premiums, or you could pay them with other money, but somebody somehow has to pay that full premium every year. The billed premium can never be changed. And that protects the policyholder from ever, being in a situation where the policy would lapse.
I mean, a lot of the contracts that I like too are limited pay whole life. So you don't pay premiums your whole life. You pay for a limited time frame that you can set up at contract issue. So like 10 pays, 20 pays, paid up at age 65. Um, are there similar contracts with IUL?
So first of all, you're right. If a whole life policy is a limited pay contract, then it has been priced so that if you just pay those 10 years or whatever that limited pay period time is, it's still guaranteed to stay in force all the way through age 121. With IUL, I've never seen an IUL. It's just a different animal. You can choose to pay for 10 years or you could choose to pay for 20 years, but there's no restriction. Usually it still allows you to pay more premiums later if you like, right? The only way to know that would be to run the illustration, and based on that guaranteed column that we talked about, the guaranteed, cash value and death benefit columns, if you illustrate a 10 premiums, look at that column. And if it's still in force all the way through age 121, then I would call that very similar to a limited pay whole life policy.
Do you think it's good for a consumer to ask their agent to run, if they have an IUL, to run an illustration with a not as linear rate of return, but put some zeros in there? Do you think that's a good idea?
Well, if you can do that, I think, and try to model different interest rate, changes, I would think that'd be a great idea. I'm not sure many illustration software packages can do that. But
I'm sure that's something they're not eager to fix either. All right. So this is a lot. You mentioned a story earlier too about a lady as she got older, the risk that some of IUL might create for someone as they're aging.
Oh, the story that I most like to recall, and this happened, I was actually on the road one time working, and it was back in 2018. I think it was April of 2018. And back in the day, do you remember when we used to have newspapers, Matt? This is a very tactile thing. It was a
I remember my
paper
dad
thing, and it came out, and you could open it, and you could look at it, and it was actually made out of paper and printed. You probably don't remember. Anyway, this newspaper was called USA Today. And especially if you're on the road and you're traveling, it was a very popular newspaper in the hotels. But I'll never forget, I turned to the money section of the USA Today, and there was this picture of a lady, and I remember her name very vividly. It was Lorraine Gunther, and she was 98 years old, and she had purchased a universal life policy. I doubt it was an IUL, but it was a universal life policy 30 years ago when she was like 68, right? And it was a very small contract. I think it was like $25,000. And of course, she bought that policy and she expected it to pay that $25,000 death benefit when she passed away. Well, so anyway, she's 98 years old and she gets a letter from the insurance company. And it says, hey, guess what? Your costs of insurance are exceeding your premiums and actually chewing up your cash value very quickly. And in fact, it looks like if you don't make changes, your policy will lapse within the next few months. And she got this letter, and you can imagine that's just not something that she probably fully understood. And so she reached out, and may have even actually, I think this article, I think, originated from Milwaukee. So it was probably an article originally in like the Milwaukee paper, and then it was picked up by USA Today. And so she reached out, and I think the reporter then helped her reach out to the insurance company to see what was going on. And the insurance company replied saying, you know what? Policies like this, a universal life type policy, make no guarantee that the policy will be carried to your, maturity or till your death. You have to, if the onus is on you, you have to make sure that the policy is being funded at a level that would keep this policy in force as long as you would expect it to be. And so at that point, and of course at 98, if the policy's in trouble, there's almost no amount of premium that can bring it. You'd almost have to pay the premium that would be worth the death benefit to bring it back. Yeah. And so, there was never a follow-up. I never followed up to see what happened, but my guess is the policy lapsed. But, it was just such a sad story because, if you put yourself in a position of a 68-year-old lady who bought a policy 30 years down the road, she's 98 and, she's probably not going to live too many more years. And to get a letter at that point, after paying 30 years, you're paying that premium 30 years. And then you get a letter that says, oh, sorry, your coverage is going away. I think that's a pretty sad situation.
Can't imagine. And honestly, I hear it often. I deal with a lot of clients and their parents, and I hear those stories often where the policy is not doing what it was expected to do because the market didn't do what they assumed it was going to do. So that is sad especially when you get older, because they don't have the time or the money to pivot, or to keep it going. Very sad. So we'll make sure I'll put a link in the description so they can download that article. Anybody listening can download that article and read about Lorraine Gunther and what happened to her policy a few years ago. Clay, thank you so much for hanging out with me today, man. Any final thoughts?
Oh, no, I just thank you for allowing me to be on your podcast. I always enjoy talking about life insurance. Obviously, it's been my career for a long time. And, I wish you the best. And anyone who's listening, I wish you the best as well. Absolutely.
If anybody has questions about whole life or IUL or has existing policies they want someone to look at, feel free to reach out to us. We have plenty of ways to get a hold of us in the comments and the description below. But Clay, thanks again for being here, man.
Thank you, Matt.
See ya.